So the term internal rate of return. The internal rate of return is the rate of return that equates the present value of future cash flows with the opportunity cost. Yeah, that is the internal rate of return. Okay, so it's C. So 1 is C. Okay, so 2 is C again, so it's exactly the same question. Okay, so it's exactly the same question again here, which is 3B. So an investment will cost 900,000 to 200,000 per year for the next 6 years. So that's just a slight variation here. So you would just change, in this instance, you would just put 6 years here. So you would just go 1, 2, 3, 4, 5, 6. You got 900,000, which is your investment amount, yeah. 200,000 over 6 years. Which equals that minus that. And just do that year in year. Yeah. 100,000 you get in year 4, so you get to year 4, 100,000 you pay back because you've taken 200,000 each year because you're paying back your investment. And that's going to be 4.5 years. Yeah, because you got 100,000 to pay back in year 4. You earn 200,000 in year 5, so you do it in a linear relationship. So yeah, you would just divide this amount by this. So you would just do it like this. Yeah, this divided by this. 0.5, so 4.5 years, or that would be 4 years and 6 months if you were to times it by 12. Yeah, that would be 12. Yeah, 6. So 4.5 years. The following internal rates of return of a project are calculated for 2 projects. Remember what we did in the last video. IRR is 10% for project X and 14% for project Y. What investment decision should be taken as the cost of capital is 12%. Remember what we said. Your IRR should be above, greater than, or equal to your cost of capital. So you would accept project Y and reject project X, because 14% for project Y is the IRR. 10% for project X, so it should be rejected. Using a discount rate of 8%, the present value of 15,000 received in 2 years from now is what? So you would look down that, so you take 15,000, look down here, and you get 8%, so 2 years at 8%. 2 years here, 8%, 0.857. 0.857 equals that, times that. So it should be 12,855. Okay. There you go, C. Which of the following gives the best definition of CAPM? Remember what we said, we did this last time. So it would be B. So systematic risk as measured by beta is one of key factors affecting the level of return required on a share for a completely diversified investor. That is the correct answer. So it's 7B. Which of the following correctly illustrates the pecking order theory? So pecking order theory says that a firm chooses its financing through the easiest and cheapest methods possible. So internally generated funds are the cheapest, borrowings are the next cheapest, and then equity is the most expensive. So the answer is C there. So a vertical takeover is a combination of 2 companies operating at different stages of production within the same industry. So that is correct. Yeah. So that's A. Yeah. So 9 is A. 10 we did last time. So which of the following parties, according to it, is most likely to benefit from takeover activity? We discussed this last time, and given what we discussed last time, it would be the most likely people to benefit are the target company shareholders, because they will get paid a premium of the acquisition price. Okay. The main objective of a firm, this is standard financial theory, is to maximize shareholder wealth. So that's 11B. So we did this last time as well. So Amershon has 1.5 million shares outstanding. It wishes to offer 500,000 new ones with a rights issue. So you would just do 1.5 divided by 0.5, which is 3. Again, it would be a 1 for 3. The answer is the same as last time. So 12C. Semi-strong efficiency. Semi-strong form market efficiency means that it's possible to earn abnormal returns. Yeah, so semi-strong form market efficiency means it is possible to earn abnormal returns from insider trading. You can. A security with them, so it's B. So a security with a value of beta equal to 0.2 is a defensive security, because this means that it's less risky than the market. So if it's less risky than the market, it's considered a defensive strategy, because when the market falls, this equity or this security will not fall as much. Okay. A zero dividend policy, is all of the above, because we know that B and C are correct, because it gives no dividends payments to investors and is attractive to investors preferring capital gains. Generally, when a company pays zero dividends, it's because they have lots of projects that they're investing in and generating a higher return. So that gets reflected in the share price. Okay, so those people that prefer capital gains will prefer a zero dividend policy. So number 17, agency issues arise when when the business is wholly owned by directors. That's incorrect. Business expands it. Okay. Agency issues arise. Well, it could arise in any one of B. I mean, B and C don't really make sense. So it's going to be D, because that's when shareholders get into ownership. So agency issues arise when there's a separation of ownership and control. So the people that are controlling the business, the directors, don't act in the best interest of the shareholders, which are the owners. So agency issues will arise at that case. So the answer is D. Modigliani and Miller's theory of capital structure, proposition 1, proposes that a company's value is independent of its capital structure, as we discussed last time in the previous video. Which of the following is an advantage of equity to the company in comparison to debt? That it's 19A. They don't have to pay. And they don't have to pay dividends. So yeah, they have to pay their interest payments by law, but they don't have to pay dividends. So that's an advantage of equity over debt. The cost of equity is higher than debt. The cost of issuing equity is more than debt, and the treatment of dividends is not tax deductible. So none of those things are a benefit. The price of a share is 4.25. Earnings per share are 9.95. What is the current price earnings ratio? So all the price earnings ratio is literally just the share price over the earnings, and what it's meant to tell you is what investors believe profits will be at one point in time. So if they're saying shares are worth 4.25, you've got earnings of 95p per share, then they're saying that they expect profits eventually to reach 4.25 per share. So, and that's 4.47 is the earnings, so it's C. So you just divide 4.25 over 95. All right.